Welcome to our third episode on the Forex and Crypto Trading tutorial. Remember, on the last episode we talked about candlesticks, how they form and how they are used. On this episode we'll be talking about support and resistance levels. Support and resistance levels are these areas on the chart where price frequently get rejected or get a pullback after a rise or fall in price. At support levels there are more buyers compared to sellers, and more buyers means more buying pressure. So each time price drops to that level, it gets a push to the upside, showing the emergence of buyers at that level. At resistance levels, there are more sellers, and more sellers mean more selling pressure. So each time price rises to that level, it gets a push to the downside, showing the emergence of sellers at that level. Support and resistance are not the same as demand and supply, as most traders may think, but they have a little bit of similarity. Support level and resistance levels are formed when a demand or supply zone is revisited. What do I mean by this?
If price of an asset is dropping and suddenly it starts consolidating at some point before it continues dropping, now this area of consolidation becomes your supply zone, and traders will tend to place sell orders at this area because the market will try to push back to that area to fill those orders before going down further. Now, if by chance the market goes back to that area, it will get a pushback again, making that area a resistance level because there are now more sellers at this area than buyers. Similarly, when the market rises to a certain level and starts consolidating before pushing further to the upside, that level of consolidation becomes your demand zone, and traders will tend to place their buy orders at that area. This is because the market might eventually drop again to that level to fill those orders before pushing further to the upside. If the market drops again for a second time to that same level, it becomes your support level. So each time the market drops to that level, it gets a push to the upside, validating the support level.
It is also important to know that the more a support or resistance level is visited, the weaker it gets until it's eventually flipped or broken. And when a support level is broken, it turns to resistance level. When a resistance level is broken, it turns to support level. Why is this so? When a support level is broken, the market is expected to continue downwards. This leads to more selling pressure at that level. Hence, when market rises to that level again, there will be a push to the downside, showing the emergence of sellers at that level, which used to be a support level, making it a resistance level. When a resistance level is broken, the market is expected to continue going upwards. Therefore, there will be more buyers at that level, which used to be a resistance level. More buyers means more buying pressure. So each time price drops again to that level, which used to be a resistance level, there will be more buying pressure, pushing the price to the upside, thereby turning that level to a support level. On the next episode, we'll talk about chart patterns, how they form and how you can use them to your advantage in predicting the direction of the market.